Friends, thank you for being here today. What if I told you that the two newest, biggest ideas to save the American economy are actually just sophisticated traps? What if the solutions being offered to you, the very things meant to provide relief, are really just a choice between two different kinds of financial poison? In a climate of profound economic anxiety and persistent consumer strain, two radical and deeply controversial proposals have been thrust into the public consciousness. These ideas, presented as solutions to the crushing affordability crisis facing millions of Americans, diverge dramatically from conventional economic policy, sparking intense debate over their viability, their true beneficiaries, and their potential to either rescue or ruin an already fragile economy. The first of these proposals is the 50-year mortgage. This concept is ostensibly designed with a simple and appealing objective to lower the monthly mortgage payments for homebuyers, thereby making the dream of homeownership more accessible. In an era defined by soaring housing prices and prohibitive interest rates, the 50-year loan is framed as a lifeline, an innovative tool to improve housing affordability and allow more Americans to purchase a home. The second proposal, running parallel in its populist appeal, is the $2,000 stimulus, also referred to as a dividend. This plan calls for a direct payment of at least $2,000 to be sent to every American, with the notable exclusion of high-income earners. The stated funding source for this massive cash injection is as unconventional as the proposal itself: revenue generated from national tariffs. Proponents claim these tariffs are already bringing in trillions of dollars, a figure that is itself a subject of fierce contention, and are doing so allegedly with almost no inflation. Together, these two proposals represent a significant and high stakes gamble, promising immediate relief while raising fundamental questions about debt, inflation, and the long term economic health of the nation. So let's dig into that first proposal, the 50-year mortgage, and see what the numbers actually say. At first glance, the 50-year mortgage appears to offer a clear benefit: a lower monthly payment. However, a detailed mathematical analysis reveals a devastating trade off, one that fundamentally alters the relationship between a homeowner and their debt. To understand the implications, a direct comparison is essential. Let us first consider the current standard, the 30-year fixed rate mortgage. Using a representative example of a $450,000 loan at a 6% interest rate, the monthly principal and interest payment comes to approximately $2,697. Over the 30-year life of this loan, the borrower will pay a staggering $521,000 in total interest, more than the original cost of the home. During the first year of this loan, the borrower pays down approximately $5,500 in principal. A critical milestone in this traditional loan occurs 19 years in, when the borrower's monthly payment finally begins to consist of more principal than interest. Now, let us apply the same $450,000 loan amount and 6% interest rate to the proposed 50-year mortgage. The monthly payment does indeed fall, dropping to approximately $2,368. The benefit, therefore, is an immediate monthly saving of $329. This level of payment relief, it is worth noting, is merely comparable to the mortgage payments seen in mid-2023, hardly a return to an era of genuine affordability. But this modest monthly saving comes at a truly catastrophic cost. The total interest paid over the life of this 50-year loan skyrockets to approximately $971,000. This represents an increase of over $450,000 in interest compared to the 30-year loan. The trade-off is stark and brutal. To save $329 per month, the borrower must agree to pay an extra $450,000, the entire original loan amount, all over again in pure interest. The amortization schedule for the 50-year loan reveals an even more insidious reality. In the first year, the borrower pays down a paltry $1,400 in principal. The homeowner is essentially renting their money from the bank. The comparison to the 30-year loan is horrifying. It takes a full 22 years on a 50-year mortgage to pay down the same amount of principal, approximately $5,100, that a 30-year borrower pays down in their very first year. The break even point where principal payments finally exceed interest is pushed so far into the future as to be irrelevant for most of the borrower's life. It takes 39 years before the scale finally tips in the homeowner's favor. But the problems go far beyond just the amortization schedule. Beyond the shocking math, the 50-year mortgage concept is riddled with critical flaws, the most significant of which is the principle of diminishing returns. The leap from a 15-year mortgage to a 30-year mortgage is substantial, increasing a buyer's affordability by approximately 34%. This is why the 30-year loan became the standard. It truly opened the market. The leap from a 30-year to a 50-year loan, however, provides a shockingly minimal benefit. Affordability is increased by only 8 to 10%. This tiny gain is the entire upside for which the borrower trades $500,000 and 2 extra decades of debt. This calculation, however, is based on a false premise that a 50-year loan would be offered at the same interest rate as a 30-year loan. This is a logistical impossibility. Lenders price their products based on risk, and a 50-year loan represents a massive, unprecedented risk. Tying up capital for half a century through countless economic cycles would require a significant risk premium. It is far more likely that a 50-year loan would carry an interest rate closer to 7%. And here the entire proposal collapses under its own weight. If one recalculates the scenario with a 7% interest rate on a $500,000 loan, the monthly payment for a 50-year term would be approximately $3,008. A 30-year loan for the same amount at 6% would be $3,000 per month. In a realistic scenario, the 50-year mortgage could be more expensive on a monthly basis, completely negating its one and only stated objective. The most dangerous flaw is the near total lack of equity building. For the first 1 or 2 decades, the 50-year mortgage functions as little more than an interest-only loan. This is catastrophic when paired with real-world homeowner behavior. The average American homeowner holds their home for approximately 12 years before selling. In a traditional loan, this is enough time to build a modest but real equity stake. On a 50-year loan, a borrower who sells after 12 years would have built almost zero equity. After subtracting the standard 6% for closing costs, it is entirely possible that the seller would walk away with less than their original down payment, or worse, find themselves underwater and owing money to complete the sale. This financial trap is amplified by a demographic one. The average age of a first-time home buyer in America has reached an all-time high, hovering between 40 and 47 years old. A 50-year mortgage taken out at this age would extend until the borrower is 90 to 97 years old. This is not a financial instrument, it is a life sentence. It creates a forever debt that traps owners in place, effectively killing job mobility. It is a loan designed to be paid for one's entire life and ensures that the borrower will die long before the home is ever truly theirs. Finally, the 50-year mortgage would not fix the affordability crisis. It would almost certainly make it worse. This proposal does not create a single new housing unit. Instead, it pours more fuel on the demand side of the equation. Sellers and builders, aware that buyers can afford a slightly lower payment, would do the rational thing. They would surge their prices higher, immediately absorbing any and all perceived affordability gains. The barrier to entry would not be lowered. The entire price structure of the market would simply be jacked up to a new, even more inflated level. Now, you might be thinking, could this even happen? Is it even legal? That brings us to the next major problem, the regulatory and market hurdles. The 50-year mortgage is not just a bad idea, it is almost certainly an unworkable one. Its implementation would face massive regulatory and market based hurdles. The post 2008 financial crisis reforms, primarily the Dodd Frank Wall Street Reform and Consumer Protection Act, explicitly limit the definition of a qualified mortgage QM to a maximum term of 30 years. A qualified mortgage provides lenders with crucial legal protections against borrower lawsuits, making them safer and therefore cheaper to issue. A 50-year loan would, by definition, be a non QM loan. This would place all the risk and liability squarely back on the bank. To compensate for this massive new legal and financial risk, lenders would be forced to charge significantly higher interest rates, once again defeating the entire purpose of the loan. While it is true that other consumer protections from Dodd-Frank, such as strict debt-to-income DTI ratios, have been weakened over time, leading some to argue the 30-year term limit could also be revised. The fundamental market dynamics remain. The most significant hurdle is the secondary market. The American mortgage system functions because lenders do not typically hold the loans they issue. They bundle them and sell them as mortgage-backed securities to investors on Wall Street. This is what provides the liquidity for them to issue new loans. The 30-year mortgage market is stable and viable because it is implicitly tied to the 10-year Treasury yield, a reflection of the fact that most homeowners sell or refinance within 10 to 12 years. A 50-year loan, however, is a black hole of risk for an investor. It creates a non-negotiable lose-lose scenario for the bank or investor holding the debt. If interest rates fall at any point in the next 50 years, the borrower will, of course, refinance. The investor loses their high yield asset and is forced to reinvest at the new lower rate. Conversely, if interest rates rise, the investor is stuck holding a low yielding, underperforming asset for 50 years, suffering massive opportunity cost and effective losses. This risk is so profound that the interest rate required to make such a product viable for an investor would have to be so unviably high that no borrower would ever take it. So when you add it all up, when you calculate the math and look at the market realities, a very clear picture emerges about who this really helps and who it hurts. When the math is calculated, the flaws exposed, and the market realities considered, the picture of the 50-year mortgage becomes crystal clear. It is a solution in search of a problem, one that benefits a very select few at the expense of the many. The clear winners are the banks and mortgage lenders who would stand to collect hundreds of thousands of dollars in additional interest, and the home builders who could use the new loan to justify even higher prices for their inventory. The clear and unequivocal losers would be the mom and pop borrowers, the very people this loan claims to help. They would be lured by the promise of a slightly lower payment into a trap of forever debt, building no equity, sacrificing their mobility, and dedicating their entire working lives to paying off a loan that will outlive them. This is not a new idea. It is a direct echo of the predatory 40-year and interest only mortgages that were a hallmark of the 2008 financial crisis. It is a mechanism for transferring wealth from the working class to the financial class, disguised as a helping hand. This 50-year mortgage proposal, however, is not the only radical economic intervention being floated. Running in tandem is the promise of a $2,000 stimulus check or dividend for most Americans. Like the mortgage, this proposal is built on a foundation of populist appeal and deeply questionable mathematics. And just like the mortgage, the first and most obvious question is, how would this be paid for? This brings us to the funding myth. The central claim of the stimulus proposal is that it will be paid for by a windfall of revenue from tariffs, which are alleged to have brought in trillions of dollars. This claim is not just an exaggeration, it is a mathematical fabrication. According to all available data, the total tariff revenue collected this year is reported to be between $90 billion and $215 billion. While this is a substantial sum, it is nowhere near trillions. The cost of the program, meanwhile, would be enormous. Sending a $2,000 check to the approximately 130 million to 250 million eligible adults would cost the federal government between $260 billion and $600 billion. The conclusion is inescapable. The stimulus program is not and cannot be funded by tariffs. The program would cost, at a minimum, substantially more than every single dollar collected from tariffs, and perhaps 3 times as much. It would not be a dividend from a national surplus. It would be a massive new expenditure funded entirely by adding to the national deficit. But even if we just ignore that false funding mechanism, the economic consequences of actually doing this would be immediate and severe. Beyond the false funding mechanism, the economic consequences of such a stimulus would be immediate and severe, primarily by turbocharging inflation. The proposal is, in fact, doubly inflationary. First, the tariffs themselves are an inflationary force. Economic analysis suggests that as much as 88% of the cost of a tariff is not paid by the foreign exporter, but is passed directly through to American consumers and businesses in the form of higher prices. This tariff tax is already estimated to be contributing between 0.5 and 1.0% to the existing inflation rate. Second, the stimulus check itself would be a massive demand side shock. Injecting $300 billion to $600 billion in cash directly into the consumer economy is profoundly inflationary. This action would be in direct conflict with the Federal Reserve's ongoing efforts to tame inflation by raising interest rates and cooling the economy. It would be stepping on the economic accelerator while the central bank is pumping the brakes, creating a chaotic and unpredictable sticky inflation cycle where prices rise and then refuse to come back down. This sugar high of $2,000 would be quickly eroded by the very inflation it helps to create, as businesses already facing higher tariff-related costs, would inevitably raise their prices to meet the new surge in demand. Furthermore, there is a significant risk that the stimulus would fail to stimulate anything at all, just as the 2008 Bush era stimulus did. At that time, checks were issued to a public that was weak, fearful of job losses, and already indebted. The result? Consumers, acting rationally, did not spend the money. They used it for essential debt repayment or put it directly into savings to weather the coming storm. The stimulus had almost no positive economic effect on consumer spending, but succeeded in increasing the national debt. With consumer confidence low and household debt at record highs, there is a very real possibility that history would repeat itself. On top of the math and the inflation, there are massive political and legal headwinds that complicate this entire idea. The timing and even the very nature of this proposed stimulus are complicated by significant political and legal headwinds. The primary funding source cited, the AIPA tariffs, is currently being challenged before the Supreme Court on the grounds of its legality. A ruling on this case is expected between February and May of the coming year. This has led to a 4D chess theory that the administration may attempt to rush the stimulus checks out the door, perhaps in January, before the Supreme Court has a chance to rule. If the court subsequently rules the tariffs illegal, the administration could find itself in a major political standoff, claiming the money is already spent and cannot be clawed back, effectively daring the court to enforce its ruling. There is also a strong possibility that the $2,000 dividend is not a direct check at all. Some analyses suggest this figure may simply be a rhetorical calculation, representing the combined value of other proposed tax cuts, such as no tax on tips, no tax on overtime, or no tax on Social Security. In this scenario, no one would receive a check. An even more cynical take suggests the $2,000 could be a quiet government transfer, not to citizens' pockets, but to subsidize the collapsing Affordable Care Act, ACA, paying off insurance companies to prevent a politically disastrous premium hike. In this case, the dividend would be a phantom, a pure accounting trick. These two radical proposals, the 50-year mortgage and the $2,000 stimulus, are not being floated in a vacuum. They are being presented as desperate solutions because the underlying economic reality for a vast number of Americans is already a waking crisis. The pressure to do something is immense as multiple economic strains are converging on households simultaneously. The government itself is in a state of dysfunction, experiencing the longest shutdown in its history. This is not an abstraction. It has real-world consequences, including for the 42 million Americans who are now losing their SNAP food stamp benefits just weeks before the Thanksgiving holiday, creating a massive new wave of food insecurity. The healthcare system is on a similar precipice. The Affordable Care Act, ACA, is set to expire at the end of the year. If it does, 15 million Americans are threatened with the immediate loss of their health coverage, while another 24 million who rely on the program could see their insurance premiums skyrocket by an average of 75%. The nation's infrastructure is showing signs of critical strain, with air traffic control shortages leading to 10% flight cancellations at major hubs, disrupting travel and commerce. And small businesses, the backbone of the economy, are openly warning of mass layoffs in 2026 if they do not see a blockbuster holiday sales season, as they are teetering on the edge of solvency. But the single greatest driver of this crisis is the wage and debt imbalance. While wages may have recently and narrowly ticked above the official inflation rate, this fails to capture the accumulated damage. Households are still crushed by the massive, unrecoverable debt they incurred during the 2021 to 2023 period, when rampant inflation far outpaced any and all income gains. They are not just treading water, they are drowning in the wake of a storm that has already passed. And these new proposals are being offered as a choice between two different kinds of anchors. Given the severe flaws in both the 50-year mortgage and the $2,000 stimulus, it is essential to consider alternative perspectives on the root causes of the crisis, which in turn point to different, perhaps more fundamental solutions. One perspective argues that the entire system is built on a foundation of fraudulent overvaluation and decades of unrestrained money printing by the Federal Reserve. In this view, the problem is not a lack of liquidity. The problem is that the compound interest on this fraudulent debt has now outstripped the real economy's ability to pay for it. The money simply does not exist. From this viewpoint, the 50-year mortgage is not a solution, but a continuation of the fraud, a desperate attempt to push the can down the road one last time by extending the timeline of the unpayable debt. The proposed real solutions are far more radical. First, repeal all property taxes, which are seen as a tool of this fraudulent valuation. Second, replace that revenue with a uniform state sales tax, a move that would be inherently deflationary. And third, to stop the cycle permanently, abolish the Federal Reserve, the engine of the money printing that created the crisis. A second, more conventional perspective argues that the housing crisis is not at its core a problem of financing or payment affordability. The problem is a critical, decades long structural deficit of inventory. There are simply not enough homes for people to buy. Adding more demand side fuel, like the 50-year mortgage, to a supply starved market will only ever result in one thing: higher prices. The solutions from this perspective are entirely focused on unlocking supply. First, to incentivize existing homeowners, many of whom are locked into their homes, to sell. The capital gains exclusion on a primary residence sale should be increased from $500,000 to $1 million and subsequently indexed to inflation. Second, the system should allow for mortgage portability, a crucial reform that would permit homeowners with low interest rate loans to port that existing mortgage to their next home, unlocking a massive tranche of inventory. Finally, to encourage new construction and buying, the mortgage interest deduction limit should be expanded. These two perspectives, while vastly different, share a common theme. They identify a root cause and propose a structural solution. They stand in stark contrast to the 50-year mortgage and the $2,000 stimulus, which are seen as short-term inflationary gimmicks that fail to address the fundamental problems, instead offering a path to deeper debt and greater economic instability. So let's be perfectly clear about what we're facing. This isn't just a debate between two different policies. This is about the very nature of the solutions we're being offered in a time of crisis. What we are being presented with is a classic false choice. It's an illusion of help, a political anesthetic designed to numb the pain of the broader economic crisis without ever addressing the disease. These two proposals are not opposing ideas. They are two heads of the same hydra, both feeding on the same public desperation. Think about the psychology at play. When you're drowning, as so many households are, you don't ask about the long term structural integrity of the lifeline being thrown to you. You just grab it. The 50-year mortgage is that lifeline. It offers an immediate, tangible $329 a month breath of air. The advocates for this plan are counting on the fact that families are too desperate to do the 30-year amortization math. They are banking on the hope that people will choose immediate relief, even if it means signing themselves and their children into a form of generational debt servitude. The $2,000 stimulus check is the other side of that same coin. It's not a long term trap, it's a short term fireworks display. It's a injection of pure, unadulterated political adrenaline designed to make everyone feel richer for a month, just long enough to mask the reality that their grocery bills are about to permanently increase by more than the check is worth. It's a heads I win, tails you lose proposition, where the public gets a temporary sugar high and the banks and corporations get to permanently reprice their assets and goods paid for by the public in the form of inflation. This is the choice they are giving us. Do you want to be the frog in the slowly boiling pot of forever debt, or the one in the flash pan of hyperinflation? The true danger here is not just that these policies are bad, which they are. The danger is that they successfully distract us from having the real, necessary, and incredibly difficult conversations we've just touched on. We are being encouraged to argue over the terms of our financial surrender rather than demanding a different system. We are arguing about whether the 50-year loan is better than the stimulus check, when we should be arguing about why our entire system is built on systemic fraud, as one perspective holds. We should be debating why it's impossible to build enough housing in this country, as the other perspective rightly points out. We are being offered gimmicks because gimmicks are easy. They poll well. They offer a simple, telegenic promise. Real solutions like reforming our monetary system, repealing property taxes, or radically deregulating housing construction are hard. They are complex. They create new winners and new losers, but they are the actual solutions. What we must demand is an end to the gimmicks. We must refuse to choose between two different paths to financial ruin. The real choice isn't between a 50-year loan and a $2,000 check. The real choice is whether we will continue to accept these superficial fixes as a substitute for the real structural and revolutionary changes we so desperately need.